We got that down? Those steps? If you have those like kind of handy, that's helpful. Those steps written down. All right, so the next part we need to talk about is this concept of fluctuating work weeks. So some employees, they're entitled to overtime pay. They don't work regular hours every week. Like in our examples that we had, these were employees that regularly worked 40 hours or regularly worked 35 hours. So every week they had like a schedule of work. But there are some employees that don't really have a schedule for work. But they're paid a salary. And if they work overtime, they're entitled to overtime pay. Now, in the examples we gave before, we used just that common method of calculating overtime, times 1.5. In these examples, though, we're going to use the overtime premium method. Okay, so remember, that's just the multiplied by 0.5. So, for example, we've got an employee that works, maybe they work 45 hours one week, they work 35 hours the next week. They're just they're still within a range. It's not fluctuating like way outside the norm, but it varies from week to week how many hours they're going to work. In that case, employers can pay them in one of these two ways when they work overtime. So the first one, overtime is calculated by dividing our normal salary by the total number of hours worked. So if we have so in this first example, let's say we have a $2,000 weekly salary and they worked 45 hours. This is the hourly rate that will determine what their overtime rate is. Divided by, what did I say, 45? So 44.44. And they're going to get paid a premium. We're going to use the overtime premium of 0.5 to figure out the amount of overtime they're going to get paid. In this case, the $2,000 is inclusive of any overtime. So these are special methods that can be used. So we've got, what is it, 44? Whoa, I should be able to do this. Well, close. 22, 23. So we would take then the 22, 23 times the 5 hours. Whoops, yeah. That's right, 22, 23 times 5. So 111.15. And then we would add the 2,000 plus the 111.15, 21.15. Sorry, 21.115. The second method, we're going to, instead of dividing by 45 hours, we're going to divide it by 40 hours. Yeah, Regina.
Is there a reason why you're adding an extra penny to the totals? Right, instead of 44, 45?
Well, because what I did, so 44.45 divided by 2 would give me 22.22.5. So I just rounded it. Or
22.22. So that would be 22.23.
So 44.45 times 0.5.
44.44.
Oh, was it 44.44? Okay. Oh, or did I round that one? So let's see. 2,000 divided by 45. You're right, 44. Sorry. Yep. No, thank you for pointing that out. Did somebody just knock? No. All right. Thought somebody left and was trying to come in. So 2222 times 5. Thank you for, so 1110. One. Second method, we're going to take the 2,000 and divide it by 40. So the difference is what we're dividing it by to get that overtime premium. Obviously, this one is going to end up being higher because we're dividing it by a smaller number. So 50. That's a 5, not a 6. Times 0.5. So there's that premium, $25. So we still have the 5 hours of overtime. Let me do this the same way here. So 2,000. Oops, sorry. My rate, 5 times 5. So 125. So those are the two different ways for the fluctuating work week. I've got an example as well here where I've got, this is a $35,000 salary and they worked 45 hours. It shows you the two different ways of calculating it. So in this one, I didn't know what the weekly, I just gave the weekly pay here, but you'd have to calculate what the weekly pay is to get to that hourly rate, right? So if we know that it's 35,000 divided by, and they're paid, the weekly pay divided by 52 to get $673.08 per week. In the first example, we're dividing by 45 hours to get that overtime premium. So $673.08, I'm sorry, $14.96 is our regular rate. $14.90, that's what we're using for our overtime premium of $7.48 an hour. 5 hours of overtime for $7.48 for the premium. Total of $37.40 for that overtime premium, and then we're adding it to the regular salary. And in this case, they're going to get paid a little bit more because we're dividing by 40. That's the only difference between these two, is are we dividing it by the total hours worked or the 40 hours? Okay, and your problems should tell you which one to use, okay? I say should because if I remember right, there may be, in the past, I think there was one that didn't. I don't know if they fixed that or not. But, so this is if it's a fluctuating work week. So they're all over the place. So they're going to get that pay regardless of, so if the next week they work 35 hours, they're still going to get the $673.08. They're still going to get that weekly amount. Okay, they're not going to get less than that weekly amount. There's the knock. All right. Now, I get more questions about this. You do have a problem on this BELO plan in your homework. So I would advise you, if you haven't started your homework, haven't started working on it, work on it. It's due Thursday night. Especially work on the BELO plan problem, because we can come back on Thursday and I can help go through it with you. But this is the one where I get the most questions from students is on this BELO plan. So what the heck is a BELO plan? This is, again, a plan for individuals who are salaried, non-exempt, so they're entitled to overtime. They have a fluctuating work week. They have a really fluctuating work week. Like it's more varied than just fluctuating. It's super fluctuating. So, they work 30 hours one week, 60 hours another week. So I have in here, there's a link to this explanation. I'm going to go through it for you, but the document is there in your agenda. It gives you more information about a BELO plan. So what does it stand for? First off, it's a bona fide executive, administrative, or professional plan. So it's a type of arrangement that is approved under the FLSA. It's a little bit different from normal arrangements. Both the employer and the employee have to agree to it. It's for employees whose hours fluctuate irregularly from week to week, allows employers to establish a guaranteed weekly salary. So even if you worked 20 hours during the week, you're still going to get that guaranteed weekly salary amount. It is based on a predetermined number of hours. Essentially what it is the overtime is baked into this. So they're going to pay you, in your salary is included overtime up to a certain number of hours. So for example, it goes up to 60 hours, so the 20 hours of overtime would be baked into what the salary is that you're receiving, whether you work that overtime or not. Okay? It includes overtime, helps to stabilize employee earnings while also ensuring compliance for the employer. So it helps to make sure that they're not running afoul of any of those overtime rules. It ensures that they're following the rules. So here's some of the key features. It has guaranteed weekly pay. Employees will receive a fixed salary covering a certain number of straight time and overtime hours. Only applies to employees whose work hours vary unpredictably. So example, 30 hours one week, 55 hours the next week. They're just kind of all over the place. The predetermined overtime rate, it includes that overtime compensation for any hours, for the hours over 40, up to a point within the contract. So again, if the contract says we're going to pay you for 50 hours, then that salary is going to be based on 40 hours of regular time and 10 hours of overtime. It's going to be included in that. If you work less than that 50 hours, you still get paid that salary. If you work more than that 50 hours, you get paid your salary plus overtime. So it's kind of the best of both worlds for employees, really. There's a maximum and minimum hour range. It has to specify a minimum of 40 hours, a maximum of 60 hours. And since the employee's workload is unpredictable, the salary structure must account for that 1.5 time rate for any hours of overtime that are included in it. So here's an example. Employer and employee agree to a BELO plan contract that pays for up to 60 hours. The employee is paid for 55 hours at a set rate, which already includes the 50 hours of overtime. So any hours over 40, they're getting paid that 15 hours of overtime. If the employee works fewer than 55 hours, they still receive that guaranteed salary. So they're still getting paid as though they worked 55 hours. If they work more than the agreed amount, the 60 hours, then that additional overtime must be paid separately. So they've got to, if it's over and above, then they've got to get paid overtime. And it's an overtime premium. Again, not the common method, but the overtime premium. So some of the benefits, it makes the pay more predictable for both the employee and the employer. It helps with budgeting for the employer, right? They're not trying to figure out every week what they're going to be paying on a week-to-week basis. Helps with compliance, so they make sure that they're in compliance with the FLSA. It's also easier on the payroll professionals. So it's rather than trying to calculate these varied amounts from week to week, it's more consistent. If the employee has a consistent or predictable schedule, it is not suitable. It would not be used. They have to be in one of these bona fide executive, administrative, or professional roles, which is defined under the plan. I don't know exactly the definition, but there's got to be a written contract. And the Department of Labor has on their website a specific definition of what this BELO plan is. They've got a lot more information on there. And pretty strict regulations about it. So how does it work? Let me do this one first. So what you do is you calculate the salary as a wage rate multiplied by the maximum number of hours and then add 50% for overtime. That's that overtime premium amount. So let me show you. I've got an example in the here for a BELO plan. So in this example, we've got somebody who, say the agreement is for 42 hours, but they worked 45 hours. So they're going to automatically always get paid for those 2 hours of overtime, right? And you calculate that out by figuring if they're making, and I get this 1683 from the above examples. I just pulled out, it's still a $35,000 salary. So that $16.83 per hour is based on those above examples. They worked 42, their contract is for 42 hours. That means that their regular salary is going to include those 2 hours of overtime. So we would take the $16.83 times 42 hours. Again, we're using the overtime premium method here. Regular hours, $708.86, and then we'd add that overtime premium, which is based on half of the regular rate, so $842, and then so the 2 hours of overtime would be $16.84. So their total regular salary, all of these calculations are just to calculate what their regular salary is, what they're going to get paid up to 42 hours, whether they work those 42 hours or not. So $708.86 plus $16.84. So they're going to get paid $725.70. That's their regular salary when they work any hours up to 42 hours. Now, if they work over 42 hours, they're going to get paid $16.83. I have 1.5 there. I don't know why I have 1.5 there. I think, hold on a second. I'm going to have to double check that. I don't know why I have 1.5 there. I think that should be 0.5. 1683 times 0.5. I don't think that's right. Let me verify that before you pay too much attention to it. But the point being that they would make, so because they worked 45 hours, they're going to get an amount over and above the regular salary of $725.70, because this assumes that they worked 42 hours. They've got to get paid for those extra 3 hours. Sorry about that. I'm looking for a pen. I'll let you know if I correct that. Okay. If I don't write it down, I'll forget. Most of you aren't to that age yet, but. Okay. All right, so below 0.5 or 1.5 additional. Because I would have gotten that 1.5 from somewhere. The slide says 0.5. All right. So, let me see if it says here. Because it says here 1.5. Salary structure, well, that's 1.5. Okay, let me, I got to double check that, see which one's right. Close that. All right.